Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
Okay, so we were asked by a fellow YouTuber, a real estate YouTuber, Robert Adams.
Hi, Robert.
Hi, Robert. To do a specific video about affordability of homes and how it's affected by small changes in interest rates. Okay, so we're going to talk about a couple things, and this is a really good video. You're going to have to watch it to the end, and you have to share this with your friends and like it. You have to do those things, okay? It's very critical that people get this information. If you want to watch Robert's videos are way better than ours because they're very much better produced.
Yes.
Okay, I produce mine. Robert has somebody who's talented.
And Robert's got like a studio. It's just so much better.
It's great.
And he's got great audio.
He's got great. Everything's great. So I'm going to put a link right here. There'll be a thing up here, hopefully, where it's able to work. If not, it'll be down there, okay? And it's a link to his channel. You can subscribe to Robert's channel. Okay, so we're going to throw up the first slide. Now, what we're going to talk about is buying a home. It's a $330,000 purchase price and with a 20% down payment. Now you can change the numbers and the down payment and the numbers change, but we're just using this as an example. So your total loan amount is $264,000. This is right now kind of a median home for most of you. This is an issue because if you make $1 million, you don't really care. But if you're kind of this, that your payment, you can't pay more than $1,400. This is really important information for you, right? Okay. So total loan amount $264,000. Now you have three columns: interest payment and total interest over the life of the loan. Now, at a 3.5% payment or interest rate on a $264,000 loan, your payment's $1,468. Okay. Principal, interest, taxes, insurance. We estimated taxes, insurance, right? So the total interest, though, paid over the life of the loan, $162,900. Ouch. Now, if you just get if you get a better loan, 0.5%, $1,396. So you're probably saying, wait. But that a whole 0.5%, it's only like $70 different in payment. And you're probably thinking, $70, I can swing $70. That's not much, right? I just won't go out to dinner that one time, right? But look at the amount of total interest you pay over the 30-year life of the loan. It's $136,000. So it's like substantially less. It's like $26,000 more dollars you pay because your interest rate was 0.5%.
It's a lot of money.
It's a lot of money. Now, you look at 2.5%, $1,326. Now it's some change because it's $140 less than the 3.5%. But look at the amount of total interest you pay, $111,000, which is like $51,000.
Also known as a Tesla.
We could buy a Tesla for the $51,000. You could literally. So you're saying, well, but aren't we all just kind of stuck at whatever rate there is? No, because remember, interest rate will change based on two things. One, how much, like buying down the loan, points and things like that, and then your credit. So if you have really good credit, you tend to get better rates, and people who get not so good credit, they tend to get worse rates.
Right, and then also keep in mind that it also depends on loan product. So if you can get like a VA loan, those have really good rates. So it depends on what you qualify for. Do not underestimate loan program changes as a way for you to get a better loan.
Yeah. Okay. So now what we're going to do is we're going to jump to the next slide. Next slide is super important because what we did was we just fixed the monthly payment at $1,500. So it's the same as before. You're putting 20% down, and instead of worrying about what the house is worth, you went to your loan officer and said, I think I can make a $1,500 a month payment. And they go, okay, great. So at a 3.5% interest rate, that $1,500 a month payment gets you a $338,000 house, right?
Not bad.
Not bad. However, if interest rates are 3%, so just a half a rate better, all of a sudden your purchase price, you can buy a bigger house. You could buy a $356,000 house. So as interest rates go down at the same fixed monthly payment, you buy more house. And you're probably thinking, well, is this really big of a deal? Why don't I just buy the $338,000 house? Well, we're going to explain that in a minute on the next slide, okay? And then at 2.5%, that $1,500 payment gets you buy a $375,000 house. Now, the big deal here is, what if the house you've always wanted, the home of your dreams. It has a pool, it's in the part of town, the school district you want to live, it's accessible to a bunch of stuff, it's $375. But because you have bad credit, because you didn't take our advice and pay off your credit cards and not open new accounts and go, buy a bunch of furniture right before you went to buy a house, you're getting a 3.5% interest rate because your credit score is kind of, it's not that great. So you're stuck with a 338. So maybe you have sacrifice. You can't be exactly where you have a smaller house. Maybe you don't get that extra bedroom, or you have no yard, or you're kind of, you're in the neighborhood, but you're on this street, the corner. So it's a loud intersection and there's cars, motorcycles going by, right? Okay. So now what we're going to do, this is what I did. I went into the MLS and I looked at all of the houses sold between $338 and $375,000 and in the last year. And this is going to blow you away. So the next The next slide is this one. This is the amount of homes in that price range. Now, here's the deal. If your ability to pay is $1,500 a month, and you get a 3.5% loan, your friend who got the 2.5% loan in a year has the option to buy 6,600 homes that you don't have the option to buy. They have more buying power.
Right.
This is Las Vegas, 6,600. So it's between 338 and 356 in the last 12 months in the MLS. There were 3,400 homes that sold in that price range. Okay. So that means there's a 0.5% difference. Now, no agent is going to show you 3,400 homes. We're not going to show you 3,400 homes, right? But what I'm saying is that there might be a home that you really would have wanted that would have been in that price range, but you didn't have the opportunity because the letter from your lender says your max price is $338.
Right. So the point is, we want to make sure that you have the most choices for buying a home or buying an investment property. So the better your credit, the better your interest rate, the more money you have for a down payment, the more choices you have, and the better investment you can make, whether it's for your primary residence or for your investment property.
The other reason this is important is because, when I first started in real estate, I was working with a lot of newer first-time homebuyers, and they always sort of stressed I really want to buy at the very, very top of my purchase range because my income is growing. I've been making more and more every year. I just got a promotion. I'm on a sliding pay scale. I make more money. So while it's like I want to push it to the limit and then buy the house, and then because I know in 5 years it'll be really affordable for me because I'll be making more money, and I don't want to buy a house I'm not going to like just because I'm putting an extra $100 in my pocket or I'm not spending that money. But then have to go through in 5 years say I need to buy another house because I really didn't like this house in the first place, and now the price isn't a problem.
Right.
Okay. And you can also see on this chart that the difference between, and that's amazing. Those are really $20,000 bands. 3,400 homes, 3,200 homes.
Right.
And it's all driven by interest rate. So, it's interesting that we were asked to do this by another professional who is very well aware, but no one talks about this. Like, I don't think I've ever seen a video where people talked about this sensitivity. Maybe a loan officer, but like, who wants to watch loan officers' videos, right? Just kidding. Anyway, so it's very important to have good credit, to get a good interest rate because it does affect affordability. Affordability affects your ability to have choice.
Absolutely. And choices are what helps you make a better investment.
Yep. If you liked the video, please subscribe to the channel, give it a thumbs up, share it with your friends.
Hit the notification bell, leave us love notes, and if you are a lender and you would like to do a video with us, hey, give us a ring and we'll see what we can do.
Yep, we'll do that.
All right.
All right.
See you on the next video.
Bye.
Bye.